Your competitors, the ones willing to reinvest more heavily, will take that market share whilst you sit comfortably on the sidelines. Hi, and welcome to Clicked Off, the podcast for e-commerce merchants who want growth without the guesswork. I'm Jason Chappell, founder of Defiant and creator of e-commerce growth made easy. I've helped countless e-commerce brands grow, working with businesses all the way from 0 to over 50 million. Each week, I'll break down what's working, what's not, and how you can grow smarter without the fluff. Today, we're going to tackle a big topic. If you've reached a point in your business where you want to push harder for an increase in revenue or market share, not just maintain where you're at, this episode is for you. But here's a hard truth. Scaling your e-com store for top-line growth comes with some serious trade-offs. You're going to need to invest more in marketing than you ever have. You may also have to sacrifice some profit in the short term. And you'll need to be clear on how aggressive you want to be and how long you can sustain this push. Otherwise, you're going to run out of runway and all your efforts would have been for nothing. We'll talk about exactly how to do this in a way that keeps you in control of your numbers rather than burning cash blindly and hoping it all works out. Because, let's face it, hope is not a strategy. So first of all, here's the mindset shift you need to make right out of the gate. When you budget for growth, you are intentionally trading profit today for greater revenue, market share, and profit tomorrow. Now, most founders know this in theory, but when they see their profit margin shrinking on paper, they often panic and pull back. That's why it's so important to go into this with your eyes open. We're not talking about reckless spending or chasing vanity metrics. This is controlled, calculated investment in your growth. And the starting point? Cash. Ask yourself this: how much cash do I have available to invest? How much profit am I comfortable sacrificing in the short term? This isn't about draining your business dry. It's about understanding what level of investment is realistic for you right now. So let's talk about a metric that will keep you on track. Customer lifetime value to customer acquisition cost ratio, or CLV to CAC. For those of you who aren't aware, this is a ratio that tells you how much profit you make from your customer over their entire lifetime versus how much you paid to acquire them. It's a pulse check on performance and profitability. Now, there's a general rule that seems to have become gospel in the world of e-com recently, and that's that your CLV to CAC ratio should be 3-1. Lots of brands and marketing agencies set this as their North Star and aim to hit this week in and week out. The problem is that approach is not always aligned with the brand's goal. It's great if you're looking for steady incremental growth, but today that's not what we're looking for. So you can wipe that 3-1 ratio from your mind right now. It won't serve you. We're going to be pushing your CLV to CAC ratio to 2.5 or lower. So taking this more aggressive approach means we'll be trading profit for top line revenue growth, but we'll need to make sure we've got the cash or funding to back it up. If increased market share or revenue growth is your goal and you currently have a CLV to CAC ratio above 3-1, that's a sign you're being too conservative. You're taking too much profit out of the business and not reinvesting enough to grow. Now, you might feel good about that profit number, but the harsh truth is you're leaving market share on the table. And your competitors, the ones willing to reinvest more heavily, will take that market share whilst you sit comfortably on the sidelines. So step one is to figure out where your CLV to CAC ratio is today. I have a free CLV calculator that you can download that will save you a load of time trying to figure this out. The link to this is in the show notes. So once you've worked this out and reviewed your cash position, you can decide steady growth or an aggressive push. If you're finding this helpful and you want to see more content like this, hit follow, subscribe, or drop a review. It's free for you and it massively helps me keep creating practical episodes like this. So let's get back to it. Once you've decided how aggressive you want to be, it's time to build your budget. And this starts with a simple forecast. Now, don't panic if you don't already have a forecast. When I say the word forecast, I'm not talking about anything complicated or spreadsheet heavy. All it really means is putting some numbers down on paper that map out what you want your next 12 months to look like. You'll need to get down your revenue target, how much you want to sell, your profit margin, how much of that revenue you want to keep, and your costs, everything it takes to run your business each and every month. Even if it's rough, that's fine. This isn't about perfection at this moment in time. It's about giving yourself a baseline to work from instead of just guessing. If you want a full step-by-step guide to building this out with templates you can plug your numbers straight into, I walk through the whole thing inside my school community. But for now, even a back of an envelope version will give you what you need to start shaping your budget around real numbers. If you're wanting top-line revenue growth, the first place you'll need to start is to dial down your profit. Decide what level of profit you're willing to sacrifice in order to reinvest in marketing and growth. Every penny you sacrifice here will get added straight to your marketing budget. Next, you'll need to adjust your marketing spend. Plug your numbers into your forecast or a budget calculator to see how much you need to spend on acquisition in order to hit those targets. Stress test it. Ask yourself, can you comfortably cover this with cash flow? Will you still have enough for staffing, operations, and stock? If you're being really aggressive, you might find that you can't sustain your budgets purely from sales and cash alone, and that you need to invest further into the business in order to hit your numbers. This is where a lot of brands fall down. They map out an aggressive marketing budget, but forget to account for stock replenishment or cash flow gaps. Scaling doesn't work if you sell out and can't restock. Remember, growth isn't just ads, it's the operational capacity to support those ads too. Now, the next critical piece of the growth puzzle you'll need to understand is your break-even point. Even if you don't have a fancy tool or a fully built out model, you can still figure out roughly where this sits. Your break-even point is simply the point at which your revenue covers all of your costs, your products, your marketing, your overheads, but you're not yet making a profit. If you're pushing hard for growth, there might be times where you dip below break-even for a short period and run at a loss. And that's okay if you've got cash reserves or funding to support you. And if you're confident in your retention, meaning customers will come back and buy again to make those initial sales profitable over time. But if you don't have cash reserves or strong retention, you'll want to stay closer to break even or even slightly profitable and grow at a steadier pace. The key here is knowing roughly where those lines are so you can make deliberate choices rather than guessing and hoping that it works out. And if you want help working out your exact break-even marketing spend and acquisition costs, I built a calculator for that inside my school community. But even if you don't use it, just understanding this principle will put you ahead of most other brands. Once you've set your budget, Here's the hard part. Stick to it. Too many founders yo-yo between overspending when things are going well and slamming the brakes on when sales dip. Revenue and market share growth budgeting is about discipline. Keep your actions consistent and aligned with your goals. Measure your customer acquisition costs and customer lifetime value weekly or monthly, and adjust your actions based on the data, not panic. And remember, this isn't forever. Aggressive growth pushes are temporary. Once you've captured the market share or hit your revenue milestone, you'll need to pivot back to a more profit-focused budget. So here's the bottom line. If you want to grow faster, you have to be willing to invest. That investment has to be calculated, structured, and tied to the right metrics. Focus on your CLV to CAC ratio. Make sure your cash flow supports your growth plan. And don't lose sight of retention, because growth only works if those customers come back. Done right, this approach can transform your brand and leave your competitors wondering how you scaled so quickly. If you found this episode useful, share it with a fellow founder who's trying to scale. And don't forget to subscribe so you don't miss the next one. Now go run your numbers, map out your growth plan, and get ready to scale with confidence. If you need any tools or help with anything we've covered today, head on over to the e-commerce growth made easy community on School. The link is in the show notes. Thanks for joining me, and I'll see you in the next episode.